Finance Minister Arun Jaitley has proposed amalgamating the Bank of Baroda, Vijaya Bank and Dena Bank. In the process, India hopes to create the third largest globally competitive bank as far as India is concerned.
We were waiting before moving further for the situation to start turning somewhat, and therefore this major decision was taken by the alternate mechanism today to amalgamate the Bank of Baroda, Dena Bank and Vijaya Bank.
So how do we understand this sudden decision of the government to announce something which has been on the anvil but not implemented for a long period of time, which is to decide to merge three banks, which is a very different merger from the one in which subsidiaries of the State Bank of India were merged with the SBI. And here what we have is a very conscious effort to try and address the problem of non-performing assets and the possibility that one of these banks, Dena Bank, has reached a stage where unless something serious is done, it could actually reach this stage of insolvency. So what has been decided is to take three banks, which is Dena Bank, Vijaya Bank and Bank of Baroda, and to amalgamate them rather than merge them to create a whole new bank. The sort of idea seems to be, if one understands from whatever has been stated in the press conference which has been held to do this, the idea seems to be that you sort of use simple arithmetic. There's a certain, it's a small bank, which is Dena Bank, which has a relatively high net non-performing asset ratio of more than 11%. You combine that with another larger but not too large a bank, which is Vijaya Bank, which has a much lower, I think it's in the range of about 4.4 or 4.6% is the net non-performing ratio. And give both of these or attach both of these to a large Bank of Baroda, which has a 5.5 or whatever it is net non-performing asset ratio, so that at the end of it, given the relative weights of each and the fact that Vijaya Bank is in not too bad a shape, whereas Dena Bank is, you end up with an aggregate, amalgamated, non-performing asset ratio, which seems more acceptable. That seems to be the sort of simple arithmetic which is driving this process. Now, we have to immediately see one thing, that the problem is not of a small bank, because Vijaya Bank is also a small bank. So it's not that there is some kind of a sort of observed relationship between bank size and bank performance, that you get better as you become big. When you're small, you're prone to actually being in a situation where you can end up being insolvent. So therefore, there is no case here in this act. There's no case which is establishing that this is a problem which can be resolved merely by increasing the size of banks. It's being done not because of the fact that you want size. It's being done because of the fact that you need to somehow take care of Dena Bank. Now, what does this mean? I mean, we've been going through a process of bringing onto the books of banks because of the Reserve Bank of India's decision to do that, their non-performing assets, putting them under different categories, so that you could be under the PCA framework, you could be, whatever it is, you could be taken to the NCLT, to the IBC, to the bankruptcy code, etc. So what is obviously happening is that the government has decided that to the extent that these kinds of processes is going to result in a situation where there is a level of write-off with haircuts, which are inevitable when you go through these processes, relatively large write-offs, it would be necessary for the government as owner of these banks to come in and recapitalize them. And we've had these recapitalization exercises, the most recent of which was something like a 2.1 lakh or 2.2 lakh crore recapitalization promise, which of course hasn't taken place. Earlier than that, we had Indra Dhanush, which was about 70,000 crores. So if you look at it in that light, this seems to be an effort of the government to say, can I take care of this problem, address this problem without having to touch the budget? Note that the day after the press conference declaring the potential amalgamation, the finance minister also states that he's not going to violate his fiscal deficit target, which essentially means the government doesn't want to borrow or use taxpayers' money, impose new taxes, and use that money to actually recapitalize the banks to the extent that they have to provide for losses because they have to take haircuts when they write off the NPAs. So is this a workable proposition? Is this a workable proposition? Now, the point is, there is a difference between the case for consolidation, which also is not empirically grounded, which was made by the Narasimhan Committee report and others, which was basically saying that we need one or two, global-sized banks which are globally competitive and a large or a significant number of big banks, rather than having this, 20 plus banks, some of which are not all that big. Now, that was a whole idea that size matters. Here, the point is not that size matters, that this is a way of trying to address the problem where you use the fact of differential sizes to address the problem of non-performing assets. Now, the thing is that we must realize that as a mechanism to address non-performing assets, the government has tried other things. It has trying to set up asset reconstruction corporations. There was talk of setting up a bad bank. In all of those cases, finally the government would have had to step in, because who's going to fund the ARC? Who's going to fund the bad bank? Who's going to actually take care of the haircut which the banks will have to take when they hand over bad assets? So this is an attempt to try and see whether they can sidestep that without actually thinking about it. The reason I say this is that, firstly, at the end of this whole process, you're still going to have on the books of the amalgamated bank something like 5.6% net non-performing assets ratio relative to its advances. Secondly, these are the set of non-performing assets which have become non-performing at the end of a long process in which these banks, because of the role they came to play in the period of liberalization, where they substituted for the development finance institutions which were closed down and began to fund projects in areas like infrastructure and power and steel, etc., that it is because of this misuse of the public banking system to finance what the government should have either financed from its own budget or financed through support provided by the development finance institutions. Because you haven't done that, you've got into this difficulty where the banks are. So there is no guarantee that the amalgamated unit, on the basis of accumulated loans which it has given, would not begin to show additional amounts of non-performing assets, so that there is no guarantee that this is a solution at all. So the point is, if then you're really thinking of what could be behind the sort of the thinking of the government, it could be that if for a short-term period you could actually show that the balance sheet of this bank, this amalgamated bank, is not too bad, because you're giving it the benefit of a Vijaya in order to neutralize the problem of a Dena, then you can actually say that listen, I might be able to actually flog this bank. There might be somebody who, at some price, which may not be the best price, but still would be willing to take it over, so that it's no more the government's responsibility, by virtue of it being a public sector bank, that it has to take care of its capital adequacy, its solvency, etc. Now, there are two problems with this. Now, this is, in fact, this is not new. I mean, when the 1997 crisis occurred, Indonesia actually had to it took over the banks and recapitalized them and then sold them to the private sector. You clean the balance sheet and then you hand it over to the private sector. So supposing you manage to do it temporarily, well, firstly, you're not sure what is the price you'd get for this, what kind of process this is, or whether even with 5.6% private players are going to be interested in picking up these banks. But let us assume they are. And let us assume that private player, then, because of accumulated loans and the sort of lending policies it can adopt in the context of the financial liberalization, begins to accumulate new non-performing assets. Can the government sit back and say that, listen, because it's a private sector bank and not a public sector bank, I'm not going to intervene to prevent it from collapsing? It will have to intervene, because the ripple effects of failure, particularly failure of now a bunch of large banks which you've created as part of this process, is going to make it even more difficult for the government to stay out. When you have amalgamation, it creates a whole host of difficulties in terms of absorbing the labor force and integrating them into one institution. If you need to cut costs, which you'll try and do using technology to replace human labor, you'd say that now I don't need these many workers, because there would be considerable areas of overlap of these three banks in terms of facilities they provide. You can say that some are in the south and some are in the west and so on, but there is going to be overlap. So therefore there would be pressure to try and shrink the workforce in one way or another, or to sort of redeploy the workforce in ways in which it might not be in the interests of the workers themselves. And of course, there would be a period during which, despite core banking, etc., it's going to affect services. So customers too would be hurt. So employees, customers, managers, etc., are going to be affected adversely. But this is even before privatization. Once you move to privatization, you're actually going to end up with a situation where private owners function according to the most stringent cost reduction purposes. Now the point is that if that is the intention is to go and privatize in this manner, as I said, that is not going to actually resolve the problem for the government. But in the interim, it's going to have quite damaging effects on the other stakeholders in the system: clients, depositors, workers, managers, etc. And the point is, in the effort to try and stick to its neoliberal agenda of privatization, of fiscal consolidation, of wanting banks to once again begin lending, in ways which banks shouldn't be lending sometimes. This notion that financial liberalization would, over a period of time, allow the government to withdraw from the financial sphere in a capitalist economy is completely unwarranted, because the banks are too important. They are the core of the payments and settlement system. They are the essential debt pipe through which credit flows. So the government cannot step back. So if you look at it in that way, this is just another sham. This is another effort to grab at some sort of last straw and say that, can I just get this problem to go away? Not realizing that this is a problem that you have created. It requires two kinds of things. Firstly, it requires thinking back on financial liberalization such that you don't get into situations of this kind, and you have very segmented financial markets with financial institutions which serve particular purposes with the corresponding funding. And the second thing you must realize is that finally, to resolve this problem, you need to tax, garner resources. Inequality is high, is rising in this country. You can do it. Resolve the problem. Change the lending policies. Change the attitude which the state has vis-a-vis these banks, and restore them to the proper role they should play, along with other institutions which would serve particular niche markets, which is not the role of a bank which takes in short-term capital from depositors to enter into long-term lending, which is high risk, which results in liquidity risk and maturity mismatches. It's not in thinking about the interests of stakeholders in the system. It's actually thinking merely of getting itself out of the trap which its own neoliberal agenda has put it in, that the government is experimenting once more with this. So as far as I can see, this is just another attempt to try and say we are doing something. They've been saying so for a long period of time. They've done a little bit, which is far short of what they promised, and yet they're not able to get this problem to go away. And this is one more such exercise which is just not going to work.